Hi, thanks so much for joining in. You're watching the Mutual Fund Show on NDTV Profit, and my name is Alex Matthew. This show gets you actionable insight on everything mutual fund related. Now, on today's show, we're discussing a category that we don't often talk about. It's an interesting one, or actually two, and they're quite similar. So the question is, how do you differentiate between the two, and how do you make a selection? If you look at the classification that the SEBI has on mutual funds, the categorization of mutual funds, you will see that there is a separate category for contra funds and there's a separate category for value funds. I'm just reading out the definition here. Equity funds may be categorized based on valuation parameters adopted in stock selection, such as growth funds identify momentum stocks that are expected to perform better than the market, etc., etc. And you have contra funds, where contra funds are equity mutual fund schemes that take a contrarian view on the market. But if you actually think about it, in value, you're buying stocks that are trading lower than traditional valuations and they're out of favor usually. So you're effectively taking a contrarian view. Both of those have to have a minimum, the same amount rather, actually 65% invested in stocks. The rest is up to the fund manager's discretion, and that's the only restriction that they have. Let's talk about this in more detail because I found it fascinating. Mohit Gang is the co-founder and chief executive officer of Moneyfront, and Kshitiz Mahajan is the managing partner and chief executive officer of Complete Circle Wealth Solutions. Gentlemen, thanks so much for taking the time. Pleasure having you on the program. Kshitiz, I'll start with you. Do people come to you asking what the difference is, or is that only me?
Well, good afternoon, Alex. Good afternoon, Mohit. Always a pleasure with both of you on the show. So yes, you'll be surprised that there's a lot of confusion about these two strategies which goes around. And normally, the tendency is to just get into a fund which is showing a good past performance. But I think both these strategies are very different from each other as we speak. So as we say value, obviously it as the name says, it looks for those companies, businesses which are trading below its intrinsic value or on the price to earning metrics in a simple way, vis-a-vis their earning number, the P looks much lucrative vis-a-vis the earning what these companies are showing. So that's what value is, where you buy undervalued stocks and then hold on to this. This is the less riskier vis-a-vis any growth strategy on a risk parameter, and obviously vis-a-vis contrarian strategies which we do. Wherein the contra fund, where we talk, contra is totally a call which we take on a sector or a cyclical stock or a sector which is right now not doing well. So, for example, during dot-com burst in 2001, somebody is taking a call on IT sector. Between 2016 to 18-20, somebody is taking a call on a PSU bank. So I think that is something which takes a call, which is a contrarian view. I remember we used to play contra, but it's a contrarian view. That's what fund manager takes a call that yes, this cycle or this sector is not doing well. And eventually this will come up the curve because of government policies or turnaround or whatever, and then you buy that company and then you wait for the right time. But this is a little more riskier vis-a-vis growth also, and vis-a-vis value also, because you are just betting on that turnaround will happen. And so obviously there's a lot of research which goes behind while picking up stocks or businesses or sectors. But yes, then this is a bet against something which is not in favor. So this is something which is out of favor, and then you buy. And this is what is the core difference between these two strategies broadly when we talk.
And while you were speaking, Kshitiz, we were just pulling up the top performers in the value category, both on a 3-year time frame and a 5-year time frame. We've taken CAGR returns. And let's pull that up while I'm speaking as well. GM topping the list, gains of about 25.7% on a 5-year basis, 26+%. Incidentally, there are only 3 contra funds, and we have that also on the screen. SBI is standing head and shoulders above everybody else in the 5-year category and also in the 3-year category. The 5-year return CAGR standing at 30.5%. So quite the performance that has been managed by this scheme. Mohit, coming to you on this one, do you also agree with what Kshitiz has just said about the difference between the two? And is it possible that while the strategies may not be the same, at least they might rhyme?
Thank you so much, Alex, for having me on the show, and like completely agree with what Kshitij has just elaborated. I think it's very beautifully put together the difference between both the categories. Honestly, there's nothing much to add to what he has said, but yes. Look, the contrarian style might not suit everyone. That's something for the investors to realize that it is a high risk, high return kind of a strategy. You are actually either buying a falling knife or you're buying something which is completely out of flavor and you perhaps don't know why it is out of flavor, right? There could be myriad reasons why a particular sector or a particular company is out of flavor, and those reasons could be bad management, markets not realizing the right potential, or some corporate governance issues, or it's just that those have certain challenges, or historically they have faced certain challenges, or sectors facing some headwinds, right? uh, we out here in a contrarian call, we are completely and wholly relying on the acumen of the fund manager. Alex, let me spell it out very clearly that a contra fund is different from a value fund in just one dramatic way, which is that the reliance on the fund manager is very, very heavy in a contra fund because it's totally his ability to figure out that what is a contrarian by virtue of even having good governance, good financials, good fundamentals, and it will perhaps turn around, and what is actually contrarian by virtue of bad governance and other factors, and he keeps it aside, right? So it's a complete reliance on the fund manager out here, whereas in a value fund it is more about you find the right stock and waiting for the right time, right opportunity. You know that the time and opportunity will come. It's just that you have to bide your time and wait for the opportune moment to come. So value is intrinsically not a bad call. It's the right and the correct and the only perhaps recognized way of investing for a long term scenario. But contrarian could be a high risk and a high return strategy.
High reward, yeah. I want to talk, incidentally, Kshitij, about this SBI Contra Fund just to drive home a point. And in fact, it's something that has emerged when we were preparing the show as well. My producer and I were discussing it. And what he's asking is the construction of this scheme, seemingly, the portfolio, is tending towards large caps. It's got HDFC Bank, based on the last disclosure, at 5.45%, Reliance Industries at 3.8%, and then followed by GAIL, Tech Mahindra, Kotak Mahindra Bank. So it looks like a large cap. It feels like a large cap. Is it a large cap?
So, Alex, this is on a very surprising note that banking sector from 2020 onwards has not done well. If you see BFSI or Bank Nifty's is actually dragging Nifty by 3% delta. So I think there's a negative yield what Bank Nifty is generating, and the heavyweights in Bank Nifty, whether it's HDFC Bank, Kotak, Bajaj Finance, Bajaj Finserv, and I'm just taking these names for education purpose, they have actually not moved much or not generated any much returns if you see as a top holding of these strategies. So now these stocks or this sector has become more like a contrarian call which many people are taking. So this cycle has not done well. These stocks have not done well. So all these stocks will feature in value as well as contrast strategy both, because obviously there's a clear cut evaluated risk which fund manager is taking, as there's a clear cut gap between valuation and what earnings these companies are doing. So that's why you have seen that you have seen these type of holdings as top holdings or among these strategies. While coming to the large cap part, what you are asking, so it's not been driven by that. These strategies are driven by that how much large cap they have to keep. It's as a function of that they keep on picking those businesses where there is an expected turnaround and where there is a valuation mismatch which is expected. And in a fiduciary responsibility as a fund manager, he will not like to take a bigger risk. So he will further make it a bigger portfolio in terms of number of holding which he is holding. And that's how you see that these are the stocks which are as key elements or as the top holdings.
Yeah, that's a fair point. And okay, I was looking at the assets under management also of this SBI Contra, and it's not a small fund in any stretch. It's 41,000 plus, nearly 42,000 crore of assets under management. It's got 88 stocks. I want you to weigh in on this as well, Mohit. The strategy that they're employing, I think you've both described this very well. But if you are trying to look for a mutual fund scheme in this space First of all, do you differentiate? You've already said you should differentiate between value and contra. So therefore, when you go into something like this, what should your expectation be?
Look, Alex. So first, I'll try and comment on the large cap aspect of this.
Yeah.
Look, typically when you're running a contra style fund, it's very difficult to identify a fully contrarian call on the small cap space. You have enough and more opportunities out there, but it's very difficult to differentiate a good management from a bad management, and to actually differentiate whether something is right now a good contrarian pick, or it's just gone out of the business, gone completely ori because of some managerial issues and everything. So the identification part becomes extremely tough there. While in a large cap, you know that those stocks have been around, those companies, those managements have been around. They're just more contrarian by virtue of maybe the business cycle or some other thing. Like so typically all the contrarian funds, not just SBI Contra, they're pretty heavy on banking right now. Even the value funds are very heavy on banking right now. Right, because of the sheer reason what Kshitiz said, that the sector has been out of flavor for almost last 2 3 years, and few of the large heavyweight names in the Nifty, they haven't actually performed or given any positive returns for not just 3 years, but in fact full 5 year period if you were to put together. So it becomes very easy for a contrarian guy to get into those spaces. And also because the AUM is so large, which you rightly mentioned, SBI Contra is one of the oldest funds in this segment, one of the perhaps first ones to come out in the contrarian segment. And by virtue of stellar performance, I think the AUM is also ramped up quite quickly and nicely. So to place such a large AUM in small caps becomes incrementally tough, and you can't like really expand the number of stocks in a scheme beyond a particular level. So that's why they are more large cap lopsided. But yes, needless to say, today all the value and contra funds are loaded with banking. If you were to just see the similarity between a portfolio of an ICICI value discovery fund and an SBI contra fund, they have 38% identical stocks in the portfolio. So there is a decent amount of match. Having said which, 62% is differentiated also, and that's where the difference between the performance lies of a contra and a value fund.
Very well articulated. Thanks so much for that, and that answers my question. So therefore, is the interpretation right, Kshitiz, coming to you on this one? If you are a small cap, mid cap investor, and of course you should have diversification. A lot of people simply say you can go out and have 30, 30, 30, and that will also do you a good job in terms of market cap diversification. But if you are predominantly a mid cap, small cap investor, because you've got a very long term time horizon, is it that you don't venture into contra, or you don't venture into value, and where does it fit into your portfolio?
So I think value is a core part of the portfolio, if you ask me.
Yeah.
Value complements the growth strategies really very well. Mid and small cap also, as we all say, whenever you get into any mutual fund, just align it with your goal. Anything which is 10-year plus, small cap fund can be a part of that goal. Anything which is 7-year plus, a mid cap fund can be a part of that goal. And value can be a core strategy because it always keeps on looking for ideas which are undervalued and buying in the portfolio. The beauty of mutual fund is when a fund manager churns and look for a better companies, then there is no capital gain which counts. So I think that really works really well. I think 15-20% portfolio can go towards value as a core part of the portfolio. Contra can be a tactical part of the portfolio, where yes, if you have a high risk appetite, if you are getting into all these small and mid cap funds, you can actually allocate 4-5% towards contra fund also as a tactical bet, and that's why you see the number of funds are really very less, because there's very less appetite toward this type of fund. So I think one can look at adding contra if you are a very expert investor in equity market. You can actually add contra to your portfolio, and it can be a satellite part of the portfolio, not a core part of the portfolio. And at the max, you can have 5% of allocation toward this.
Mohit, I want to give you also the opportunity to talk about it. I think largely your view is the same on this, but why don't you articulate it?
Yeah, completely concur with Kshitiz that a contra has to be your satellite portfolio. It can't be a core portfolio. It requires a certain amount of risk taking and risk ability to be able to withstand that entire because the correction bouts could be fairly severe in a contra kind of a strategy. If you really were to go wrong in something which any which ways is contra, then it's a double whammy. right? So you have to be extremely cautious. It is more a tactical part of your portfolio. It can never be long term strategic part of your portfolio. Whereas value as a theme is more a style of investing, right? So you have growth style of investing, and these days you have quality, momentum, and other styles or factors coming into play. But value, for as long as we have known investments, has been the crux of all investing, right? Finding something below its intrinsic value is the real identification or the fundamental way of investing. So value will always remain as a core strategy,
Yeah.
and that should form a core part of your portfolio always.
Okay, so a couple of questions then emerge here. Since both of you are saying that it must be part of your portfolio, Kshitij, first to you, there are periods of underperformance. Each of these strategies generally go through periods of underperformance and periods of fantastic outperformance as well. But is it true that value, the period of underperformance, you should be willing to wait much longer than you would have to wait in certain other categories?
100%, Alex. Vis-a-vis growth, sometime, there is a earning growth of any business, and there is a multiple which you give depending on market scenario. Sometime your earning growth, keeps on running ahead, and the multiple has to catch up, and eventually it catches. You will not make much more than what company is earning. That's what value keeps on doing. That let's buy those businesses where there is a gap between this. Sometimes it takes some time, but as we all have moved ahead of 2020, and we have seen the cycles have shortened a lot, Alex. If you see, we all are 18, 20 years in experience in this market. There used to be commodity cycle for 3 years, 4 years, 5 years, or let's say some other sector cycles for 3 years, 4 years. Now the cycles have shortened. But yes, sometimes it can test your patience. But if you have something as a core part of the portfolio, so in a market which is volatile, in a market which is not stable enough, in a market which is rebounding from the bottoms, value will tend to do well and will do very well. Growth, obviously, in a good market as a growth strategy, business which are growing will keep on doing well. Where in contra, sometime if you are entering at a wrong side of the cycle, if the, let's say, fund manager has taken a call on few stocks which have already played their journey in terms of catching up, then you might take some time for that entire piece to recover. And yes, it can be much more riskier, as Mohit said. It can be much more volatile, and one has to take into account that, yeah, if you have a volatile part in the portfolio, it can't be more than 5%. So I think that's the right thing to do, because overall your portfolio is shielded by 95% of a core portfolio. And if 5% has some pain which is going through it, then you can still manage by overall portfolio.
Okay. Is it difficult, and this is probably something that you've dealt with, Mohit, so a quick answer to this maybe, if people have gone ahead and put value in their core strategy, if they've put Contra fund also in their portfolio, and you've advised them about this, have they come back to you often and said, hey, you know what, this is not doing well? And what do you say in that situation?
Look, Alex, as a fundamental rule, we'll never go with both value and contra in the same portfolio.
Okay.
Honestly, it doesn't make sense, right? So as a practice, we have kind of avoided that. But having said which, if there is an allocation which has come through in our site in both the things equally, my sense is value is a patience game. You have to be a lot more patient. It definitely comes back in the cycle. And when value funds perform, they really perform brilliantly in their cycles, right? So those 6 month, 1 year periods could be fantastic return periods for investors, but it's just that the wait is patient and long.
I'm glad that you spelled that out. I also have, and a quick answer to this, I also have the understanding that mutual fund houses cannot launch both value and contra, right? You can have one or the other. That's right,
Absolutely.
right? Yeah. Okay.
Yeah. That's absolutely right.
Okay.
They can't have both on the shelf.
Yeah. So therefore, pick one or the other, and remember that the contra fund should only be a satellite allocation. That's what both the gentlemen on this program have had to say. Just a quick thought at the end: if you were to select some of these schemes and schemes that you like in this category, in both, I would say there are only 3 contra funds to choose from. But Kshitij, which value and which contra? Because there are few fund houses that specialize in that value strategy, right?
Yeah. So I think ICC Value Discovery is a name which come across as the first name, and it's been doing really well for quite some time, and it's a long track record. That's one name. HDFC Capital Builder is another good name which one can look at, and Aditya Birla Value Fund is there. So I think these three funds have done, and maybe the way the portfolio is carved out will keep on going good, going ahead also. On the Contra side, you have SBI and Kotak Contra, both the funds. There are three funds only. There is another fund which is Invesco, again, which is also good. But I'm saying one can choose depending on which fund they have to look at. But right now, the portfolios looks really good, as we all have drilled down that HCF more or less they have banking as top sector allocation. So I think they will keep on doing well. But yes, one should take into account while taking their own call that we are just sharing about what we like. There is no recommendation here.
Yeah, no, that's fair. And that's why I said what I said at the start. Mohit, you want to add to that? Does anything stand out specifically to you? Any strategies that you've liked?
Look, honestly, as a fundamental rule, I'll only go with value. Unless we really want to play contra tactically in a theme, or we think the markets become too beneficial for taking a contrarian call depending on the portfolios of the fund. So for us, it's only value. And out there, I think ICICI Value Discovery just stands out in the pack.
Fantastic. Let's jump to the queries as we normally do. Just a quick reminder to everybody who's writing in, make sure you tell us your name and your location that you're writing in from. The first question today is from Balu. Balu is invested 3.5 lakh rupees as a lump sum in the Franklin Templeton US Opportunity Fund. Right now, the corpus stands at around 4.5 lakh. He's asking whether he should continue to hold. Now, we don't know what else he's holding, Kshitij. But simply on the face value of the scheme and what it does, is the strategy okay? Should he hold on?
Alex, if he's holding only Franklin US Opportunity Fund,
I hope that's not the case.
Yeah, then if it's not the case, then I think it's a good fund. It's a diversified portfolio. It's taking exposure into US equities, and it's a very, very well diversified fund. Not only focus on only IT bet in US. I think he should keep on holding this fund. It's a good fund to hold. But for the information of everyone, now whatever investment which you are doing abroad through ETF and through MF or fund of fund route in US equities, or let's say in China or any other place, it's been taxed as per tax lab. So earlier fixed income taxation used to be there, but now it's not there. So whatever money which you will make will be taken as a part of your income whenever you are going to book that income. So that thing which you have to take into account.
Yeah, the taxation is important to factor in. Yeah. Bhagesh Solanki's got the next question. He says he's 43 years old and he's asking if it's a good idea to invest in the HDFC Manufacturing Growth Fund. Mohit, thoughts on this? It's a pretty broad theme.
Yeah, in fact, it is a broad theme. Look, Make in India, manufacturing, all those have caught fancy of investors, and rightly so, for all the right reasons. Government of India is putting a lot of focus out there, and there is a lot of buzz around on the street. Having said which, any other infra fund would do as good as this one, right? So you need not just buy a fund for the name of it. Basically, I would rather go with a infra fund if I have to like really make a sectoral allocation right now, or a thematic allocation right now. An infra fund which will kind of encompass a slightly larger universe, and which will capture the buzz in the economy perhaps more so correctly. Having said which, there's nothing wrong in this if someone wants to go.
Sai's got the question that is coming up next, and I think this is something that a lot of people are asking, Kshitij, because unfortunately this is a fund house that has seen pressure in its mid-cap and small-cap space purely because of the strategy it's employed, Axis. The last 3 years have not been great. The peer comparisons will tell you that, the numbers will tell you that. The question is, should he continue to invest in these or switch to other funds as they have underperformed?
My submission here is that if there's an underperformance in a fund, and if the fund manager is sticking with the fund, and the fund house has a clear-cut view of doing the right stuff, then you should not redeem when the guards are low. You should actually keep holding onto those funds, because there is a turnaround in every fund or every fund manager story, because sometimes my bets will play, sometimes your bets will play, sometimes more bets will play. But if you have only these two funds, then it makes it a little riskier, because you have only mid and small cap fund. Then you should add more fund houses as well as more fund categories also in your portfolio. So I will suggest that if only these two funds are there, then you should add more. If you have only if you have a diversified portfolio, then maybe you can stop your SIPs if it's going in these funds, but keep on holding these funds, because cost of churn is your capital gain also, which you have to remember. You're 43 years of age, and I don't think that you will be requiring these funds anytime soon. If you're not requiring these funds anytime soon, then you should not churn this fund.
So, so therefore, incremental investments into other schemes, perhaps diversify beyond just mid and small cap is the right approach. I'm assuming that they have more than just this, and they're asking specifically this component of their portfolio is underperforming. So I think that answers the question. Thank you so much, Mohit, Kshitiz, for joining in. Always a pleasure speaking with you. And thanks so much for joining us.
Thank you.
All right, that brings us to the end of this edition of the Mutual Fund Show. It's been an interesting one. Let us know what you think in the comment section, and do stay tuned. Lots more coming up on NDTV Profit.